Module 10 to 2 P/E ratio in cyclical stocks. Interpreting the P/E ratio in the context of cyclical industries requires considering the unique characteristics and dynamics of these industries. Here are key factors to consider when interpreting the P/E ratio of cyclical companies. Stage of the economic cycle. Cyclical industries are highly influenced by the business cycle. Understanding the stage of the economic cycle is crucial for interpreting the P/E ratio. During economic expansions, when the industry is experiencing growth and increased demand, cyclical companies may have lower P/E ratios as their earnings rise. Conversely, during economic downturns or recessions, when the industry faces challenges and reduced demand, cyclical companies may have higher P/E ratios as their earnings decline. Analyzing the stage of the economic cycle helps put the P/E ratio into perspective and assess whether it is reflecting the current industry conditions. Historical P/E ratios. Comparing the current P/E ratio of a cyclical company to its historical P/E ratios can provide insights into its valuation. Reviewing the company's P/E ratios over multiple business cycles can help identify patterns and understand how the market has valued the company in different economic environments. If the current P/E ratio is significantly higher or lower than historical levels, it could indicate that the company is either overvalued or undervalued relative to its own historical performance. Peer comparison. Comparing the P/E ratio of a cyclical company to its industry peers is essential for gaining perspective on its relative valuation. Look at the P/E ratios of similar companies within the industry to assess whether the company's P/E ratio is in line with its peers. If the company has a higher P/E ratio compared to its peers, it could indicate that the market has higher growth expectations for the company or that it is considered to be a market leader. Conversely, a lower P/E ratio relative to peers may suggest that the company is viewed as having lower growth prospects or facing specific challenges within the industry. Earnings outlook. Consider the earnings outlook for the cyclical industry and the specific company. Analyze industry forecasts, economic indicators, and company-specific factors that can influence future earnings. A higher P/E ratio in a cyclical industry may be justified if there are positive expectations for future earnings growth due to factors such as increased demand, favorable market conditions, or company-specific initiatives. Conversely, a lower P/E ratio may indicate lower growth expectations or concerns about the industry's outlook. Risk assessment. Evaluate the risks associated with cyclical industries and how they may impact the company's earnings and valuation. Cyclical industries are susceptible to factors such as changes in commodity prices, interest rates, consumer spending, or global economic conditions. Assess the company's ability to manage these risks, its competitive position within the industry, and its financial strength to determine if the P/E ratio adequately reflects the associated risks. Long-term perspective. Keep a long-term perspective when interpreting the P/E ratio of cyclical companies. Cyclical industries go through cycles of expansion and contraction, and earnings can be volatile. Consider the company's ability to navigate these cycles and generate sustainable earnings over the long term. A cyclical company with a low P/E ratio may present a value opportunity if it has a strong track record, solid fundamentals, and a well-executed strategy for managing through industry cycles. Remember that the P/E ratio is just one valuation metric, and it should be considered in conjunction with other factors such as earnings growth potential, industry trends, financial health, and competitive positioning. Conduct thorough fundamental analysis, monitor industry dynamics, and consider the broader economic context to interpret the P/E ratio in the context of cyclical industries accurately.